Hello and welcome to the fifth and final talk of the Warwick Artificial Intelligence Summit. Today we're going to be speaking to Chris Dick, but before I introduce Chris, I just quickly want to mention a few things. The aim of this summit has been to spread the word of artificial intelligence. We've talked about a wide range of topics and we've discussed the applications, the implications, and all of the effects of the introduction of machine intelligence into our world. If you've been interested in everything we've spoken about, or you're interested in this talk with Chris today, then I'd urge you to check out the links in the description of this talk to go and find out what we do. Find our Discord, find our Facebook, and see the workshops, the talks, the academic expertise and the industry expertise that we can offer you. This is the fifth and final talk, but after this one, we have a careers fair where we have people from Facebook, we've got people from Google, Uber AI, the Future of Humanity Institute, McKinsey, coming to talk to you about how they got their jobs working in artificial intelligence in industry. So if you're interested in getting a job in one of these industries, then be sure to check that out just after this on the same stream. Before I introduce Chris, I quickly want to pass over to Warwick Finance Society, who without whom we wouldn't have been able to host this event. I have Val here with me, who's going to give you an introduction into specifically the quant team of WFS. Cheers, Val.
All right. Thank you very much for the warm welcome, Joe. So I'm here on behalf of WFS. WFS is the largest society on campus with 2,700 members. And we offer everything finance related from investment banking division to fintech, and also help you out with your career progression in terms of application clinics. I'm here to talk about the newly found quant team, which focuses on modeling, algorithmic trading, and writing reports, which can then be read by industry professionals. It has been a newly founded team, but by my friend Remo, and I'm here to represent him today. We have our recruitment process are currently open. So if you find this talk interesting, if you're interested into quantitative trading, into algorithmic trading, definitely look into WFS and the quant team. We are currently open, and please ask us any questions if you do. Thank you very much.
Thank you very much, Val. This talk is the last of the talks in which we're going to be giving away exclusive Warwick AI merchandise. So if you are interested, we have the last hoodie available today. So the best question that Chris is going to judge at the end, I want all of your questions. Chris is going to decide in his favor, and the winner of that will get the last hoodie that we're giving away. The last batch of those. So be sure to ask your questions in the chat, and we'll read them at the end. So without further ado, I want to introduce Chris. Chris Dick is a quantitative trader from B2C2. Building trading strategies using machine learning. Chris has a background in computer science and in mathematics, and has previously worked as a trader for Citibank for 5 years. In today's talk, Chris is going to be discussing the application of artificial intelligence to algorithmic cryptocurrency trading. If you have any questions about portfolio management, derivative trading, creating a startup, developing algorithmic trading strategies, or applying AI to trading, or even if you just want to talk about running, then Chris is your man. So without further ado, I want to pass over to Chris to give his talk. Thank you, Chris.
Cool. Thanks for the welcome, Joe. All right, so I'm going to share my screen. Let me know when you can. Cool, can you see the slides?
Yeah, that's the one. Perfect.
Great, so my name's Chris. As you said, I'm a quant trader at B2C2. So today I'm going to give a little chat about, well, the title is AI, Cryptocurrency and Algorithmic Trading, which is quite a scary title. I can't remember in fact, did I come up with it or did you? I don't remember, but either way, I'm probably going to be focusing on algorithmic trading and particularly how the industry can use machine learning to solve some of its problems. I'll mention briefly cryptocurrency because that's the asset class that we trade at B2C2, but that won't really be the focus of the talk. So, I mean, we can go into that in questions at the end if you're interested, but it's mainly going to be a high-level overview of different machine learning models that you could apply to different problems in algo trading. Cool, so I'll introduce myself. I'll talk about what B2C2 do. I'll give a quick introduction to algo trading, algorithmic trading, assuming that not everyone here knows exactly what it is. And then I'm going to go through 4 different examples of areas you could apply AI in trading: price prediction, alpha generation, parameter tuning, and execution. Cool. So who am I? I'm Chris. I went to Warwick to do maths, graduated in 2013. I became a trader in London. I was trading interest rate products, not through code, through like voice. Well, we had Excel and stuff like that, but it was mainly when we wanted to put on a trade, we spoke to somebody on a chat, or we shouted, or we pressed a button, but it wasn't all executed through code. And then after doing that for a whole bunch of years, I decided I wanted to learn how to code. I came back to Warwick and studied computer science, learned to code, and now I'm a quant trader at B2C2. So what does it mean to be a quant trader? That basically means that at B2C2, the trading team is responsible for deciding what trades to put on. So if we want to put on a trade, that has to go through us. If we decide to buy something or sell something or to have some risk, then that all goes through the trading team. And as a quant trader, we cover, I cover both the trades that we decide to do as humans and also the code that's executing trades, on a daily basis. Cool. So what is B2C2? So B2C2 is what's called a market maker. So it's a type of trading firm that gives the ability to its clients to buy or sell an asset any time of day. So 24/7, clients can come onto our platform and buy or sell, and we'll give them a price any time of day. When you think of trading firms, you probably think naturally of, let's say, hedge funds, people who are taking like a long-term view. What's the market going to do? They buy here, they sell here, and they have this kind of mandate to try and make as much money as possible over like big moves in the market. That's a bit different to the business model that we have. Instead, we offer a service to clients. We do this 24/7, as I say. We do it in a whole bunch of different cryptocurrencies. So say Bitcoin, Ethereum, Litecoin, Bitcoin Cash, a whole bunch of others. And our clients are what's called institutional only. So if I wanted to buy Bitcoin, if you wanted to buy Bitcoin, you'd have to go onto an exchange, you'd open an account, you'd be able to trade on one of the platforms like, say, Kraken or BitMEX or Coinbase or whoever. But if you wanted to trade with B2C2, you'd have to be an institutional client. So you'd have to be a hedge fund or a bank or an asset manager or someone like that. And that's just the type of client that B2C2 focuses on. Cool. So this screen here is not B2C2 screen. This is one of the exchanges. I think it's actually Coinbase. Some of you might recognize it. I took a screenshot to kind of show what it's like to try and go onto an exchange and do buy or sell some Bitcoin. And then so I can contrast it with the offering that B2C2 give, just so that you guys have a better understanding of what algorithmic market making is. So this screen's kind of confusing. At least that's the first thing I thought when I see it. You have this chart in the middle, which is obviously the price of Bitcoin. You might recognize candles, and you might have an opinion on the candles, or you might not. The price at the time I took the screenshot was just under 16,000 for a Bitcoin. And then you can see how it's moved during the day. Probably the most important part of this screen is the order book on the left. I don't know if you guys are familiar with this, but at the bottom, these are all the sizes that people sizes of Bitcoin, amounts of Bitcoin that people are waiting to buy. And these are the price that they're willing to buy. And these are all the amounts of Bitcoin they're willing to sell at these different price levels. So these numbers you can see here. So this person's waiting to sell 2 Bitcoin at a price of 63.70. They haven't yet sold it. They're waiting to do it. And then if I wanted to come and buy some Bitcoin, I could trade against this order book, and I would kind of what's called trade against these levels. So if I wanted to buy 7 Bitcoin, I could buy them at 61.56, and then another 3 here, and then another 1 here. And that's how I would be able to execute on an order book. It's actually not super straightforward. You have to put a lot of thought into it. You have to know what you're doing. These prices move around a lot. There are lots of sophisticated traders who trade on these order books. So instead, B2C2 offers a much simpler platform. And I made this on Google Slides. It's not what our website looks like, but it's very similar. If you went onto our website, you would see we have a price where you, the client, can sell Bitcoin, and a price where you, the client, can buy Bitcoin. And our job at B2C2 is to just make sure these prices are updated as regularly as possible, make sure they're as fair as possible. If you want to buy, you'd be buying at this slightly higher price here of $3, and you'd be selling at this slightly lower price here of $2. So because of that, at B2C2, we take the opposite side of the trade, and we would be buying Bitcoin low, and B2C2 would be selling Bitcoin slightly higher, and we'd be capturing this $1 spread in the middle, and that's how we make our revenue. So I hope that's relatively straightforward. Our job at B2C2 is just to figure out what the fair price is right now, offer that to you as a client, make sure that there's always 24/7 an easy way for you to click and buy and sell. And then once you've done a trade, we do the opposite side of that trade, and then we turn around and we need to go and cover our risk. So if you've just bought some Bitcoin, we've just sold some Bitcoin, and then we need to go to the exchanges, a bit like the exchanges you saw here, and cover that risk. So that's kind of what market makers do. And that's roughly what my job was at Citi, but I was doing it by voice, and now I'm doing it algorithmically. Cool. So what is algo trading? I've just explained market making, but there's a whole bunch of different types of algorithmic trading. And this talk is here to focus on AI. So I'll try and go through this as high level as possible, and we can get into some of the details later if you're interested. But algorithmic trading can come in a whole bunch of different forms. The hedge funds that take the longer term views. There's the market makers who provide different prices. There's asset managers who hold money on behalf of other people and then need good execution algorithms to enter into the trades. So if I look at the Bitcoin price, say for the last 10 years, you can see it started off around 0, and then it shot up. It actually went to 20,000, but it was there so briefly that this chart doesn't even capture that. And then it fell down again. We had a bit of a crypto winter here in 2018, and then it's recovered now, and actually we've had a good few months in terms of price, and this is how the industry works. So then if you were a hedge fund, you might take some long-term views on, okay, I think the market's reached its maximum, it's probably time to have another crypto winter, and that might be the view that you have over 6 months, or you might think it's going to keep going and go to 20,000 or even higher. But then you could also zoom in, instead of taking a long-term view, just look over the last day, and you can see on this chart the prices move between 16,400 and say like 15,700, so a much tighter range, but still reasonably volatile. Or you could zoom in even further, and in this chart you'll see like just 1 hour's worth of price movements, and actually this is more the scale that B2C2 are looking at. In fact, we're probably looking on an even smaller scale, just trying to predict what is the fair price to show our clients, right now, or in the next few seconds, or maximum over the next, say, like few minutes. And that's so the time horizon you're looking at would require different techniques for prediction, different types of machine learning models. So in the high frequency trading space where we probably sit, there's a special type of models and data you would concentrate on. Cool. So the first example of how to use AI in trading is price prediction. And I think that's probably the problem that most people think of when they think about trading. And the problem is relatively straightforward. So I took this screenshot yesterday when I was making the slides. Around 4 p.m., the market went up and then kind of plateaued for half an hour or so. And then there's suddenly this quite a drastic fall where the market fell like $200 in 20 minutes or so. And if you're sat there at 1650 and you want to predict where the market's going next, then it could go up, it could continue its fall, or it could plateau again. So then you might want to apply some machine learning models here to predict where the price is going. So here are two commonly seen machine learning models. If any of you have done like a simple statistics module, you'll have come across regression. Basic regression is basically trying to draw a line through a whole bunch of points. And then you can get more complicated, like multivariable regression, or even more complex models that do more interesting things. But a lot of people will look at regression and say, oh, it's really boring. You only learn that in like your first class of statistics and you forget about it. But actually, it's reasonably powerful, particularly because it can be calculated in such a short amount of time. So if you're actually looking at very short time frames, regression can be quite important. So in this, I won't go too much into the maths, but as I'm sure a lot of you have seen it before, but basically if you have this y hat, which is the thing you're trying to predict, and you have x, which is the features of what the world looks like right now, then you can train these weights W, and then when you take what the world looks like right now, multiply it by the model that you've trained, you get some kind of prediction. And that's like a basic but relatively interesting model that we use. So something on the more sexy end of machine learning are neural networks. Neural networks, again, can be applied to price prediction in a similar way. You have some kind of context about what the world looks like that you put in as an input on the left-hand side here. And then you have a whole bunch of weights in the middle of your neural network that you're trying to train to make some prediction out at the end. And then you take your prediction and you compare it to what actually happened. And the gap between what your prediction is and what actually happened is often called a loss function. And the aim is to pick these weights in the middle so that your predictions are as close together. Your predictions are as close together to what actually happened. So you're trying to minimize your loss function and come up with weights that make this loss function minimal. And then you can use that model to try and predict where the market's going. Neural networks, so I listened to the Warwick AI talk yesterday, DeepMind, which was super interesting, and they clearly use a lot of neural networks, a lot of deep neural networks. The downsides of neural networks is even once they're trained, they're still relatively slow to use, particularly when they get really, really big. So in some of the deep neural networks, you might see like millions and millions of parameters. And if you have millions of parameters, even if they're all just if statements in your code to compute, it can take a little bit longer than regression to come with an answer. And if you're trading sub 1 second and you're trying to do trades within like milliseconds, it's not always the fastest models, but it can be if you train them in the right way. So it's a bit of a balancing act there between speed and power. Cool. So when you have a supervised machine learning model, as you've probably seen before, you have to come up with a target of what actually you're trying to predict. And in this price prediction, we're trying to predict the change in price over some kind of horizon. So t seconds later, let's say 1, 5 seconds, 10 seconds later, how much is the market going to move up or down? So you try and predict that. And then the other side of the coin is when you have a machine learning model, you need some features that you put into the machine learning model in order to predict your target. So what kind of features could you have in price prediction? Well, one obvious example is how much has the market, if you're trying to predict how much the market's moving now, how much has it moved recently? So, over here at 3:30, it moved a little bit down, and then it, started to move back up quite a lot, and then there was a reversion. So you might put these different returns into your market. You might take an average of these returns and then say how much over the last 10 time steps on average has the market been moving. A common feature you'll see is like volatility. So that's the standard deviation of price returns, or you can think of it as like how jumpy is the market right now. Another common feature is recent market volumes. So how much are people doing trading? Are people trading a lot right now? Is it a quiet market? And if people are trading a lot, that might tell you that there's some big event happening and the market may be trending. Or if not many people are trading, it could also be quite jumpy, and then the market will say gap, or perhaps mean revert because the move wasn't a substantial one, and actually the market's going to come back to where it was. But all these different features you'll put into your machine learning model. And really, part of the job of a quant trader is to come up with really interesting features. So yes, the model is important, and yes, you have to define the target well, but coming up with super interesting features that have information is part of the secret sauce. And while these are like really standard features I put on this slide, the ones that are the most interesting, the most powerful, obviously, I don't really want to mention because they're the things that we come up with, and that's like super useful for us. So part of the interesting part of my day-to-day job is, understanding the markets and having a think about what kind of things have happened that are informative, and turning those into statistical features that we can use in our predictions. Cool. So the next example of how to use AI in training, I'm going to talk about alpha generation. Alpha generation, if you know what it is already, it's very similar to price prediction, but adds some extra layers to it. And so I looked on Investopedia for what their definition of alpha was, and they have quite a good definition. They're just saying alpha is a term to describe a strategy's ability to beat the market. So it's kind of when you think about your traditional hedge fund making a bet on the future, their alpha is trying to outsmart what everyone else thinks. Okay, and that requires much more than just price prediction. So actually, while in the previous example, our target was, say, direction and perhaps some kind of holding period, you also have to really think about when you're getting out of the trade. So that's the other side of holding period, is if I'm going to predict the market's going to go down, I need to have some kind of guess or decision about when the market's going to stop going down and when I'm going to get out of this trade, because you could have a completely different profit and loss when you get out of the trade immediately compared to when you hold the trade for 6 months, right? I mean, you might have put on a trade here and the market falls and you get out of it 30 minutes later and you've made money. But in the long run, if Bitcoin goes up to 20,000 in 2 or 3 months, then it's obvious that you would have lost money. So your holding period does matter a lot. Your size of the trade is a really interesting one. So I was listening to Paolo's fascinating talk this morning about poker and chess and other strategic games in AI. And one of the things that's important in poker is that the bet size that you do is proportional to how confident you are when you're making bets. And you might want to apply some similar analysis to trading as well, to make sure that you don't just go all in every time your model makes a prediction, because with any statistical model, it's going to be right some of the time and it's going to be wrong some of the time. And then there's stop loss and take profit, which is one way of kind of staying humble with your model and admitting that you won't always go right. So when do you cover your losses if you go wrong, or when do you take profit when things go in your favor? So I guess the point on this slide is, in price prediction, your target, you have one almost simple target, but when you're actually coming up with a trading strategy, you almost have 5 or even more targets, and it's a much more complex problem than just predicting where the market's going to go up and down. In fact, you could get the direction of the market right all the time and still, well, not all the time. You could get the direction of the market right a lot and still end up losing money if you don't get the other things right. Cool, yeah. So this is just the examples of, if you buy here and then selling here is completely different to selling here for obvious reasons. Cool. So AI for execution. Execution is a part of trading that I think is overlooked by, well, especially when I was at university, or people who just read about markets casually. Once you've come up with a decision for which way you think the market's going to move, you then have to actually put your trade on. I get dry throat when I'm talking. So AI for execution, the idea there is, even if you know where the market's going, you need to put your trade on. And it's not always that easy to do, particularly if, so we saw some order books earlier on the Coinbase page, and you could see that if I wanted to buy 100 Bitcoin, there was no volume to do that. So let's look at this next page. So here is a page from BitMEX, which is one of the exchanges that you could trade cryptocurrency on. And here's another order book. And the idea is, so let's go back to order books quickly. So when you trade via a broker or you trade via B2C2, you just click and then you manage to get your Bitcoin and you're long, and the market either goes up and you make money, or it goes down and you lose money. But if you actually take trading back to where the action really happens, it all happens on order books. So when you think of trading, you might look at the price of Apple shares on Yahoo Finance, and you see the price, and you call up your broker and you manage to buy some Apple shares. But what's ultimately happening is that there's an order book somewhere where people are waiting to buy, people are waiting to sell, and then other participants are trading against those buys and those sells. And this is the core of almost all markets these days. And this is where like the action happens. And if you're thinking about how to execute your trade and how to get the best price for the trade you want to put on, you really have to understand how order books work. So I'll revisit what I said before. So these are the different price points, and these are the different sizes that people are waiting to buy. So you can see these are in dollars. So you can see someone here is waiting, or multiple people here are waiting to buy $750,000 worth of Bitcoin at 26.5. But then after this level, it kind of thins out and not many people are waiting to do stuff. And then on the other side of the order book is actually a different situation. So there's $250,000 worth of sales waiting here, which is much smaller than the 750. But then behind that level, there's also some other chunky levels. There's 100 grand here, 170 grand here. So that's quite interesting. And you can, if you wanted to go and buy, say, $1 million worth of Bitcoin, what would you do? Because yes, you'd be able to get some at this top level here of 27, but you wouldn't be able to get the whole $1 million executed. In fact, this whole book doesn't even add up to $1 million. So you would end up, if you just put your $1 million and just bought against all these people who are waiting to sell, you would move the market then more than $5. In fact, the market probably trade much higher because you suddenly put all your buys in here, it sweeps out this side of the market, and then maybe you even keep sweeping it even higher, or maybe as you start to trade aggressively through all these levels, all the people at higher levels start getting really scared and pull their orders out. And then you can see quite clearly you're moving into some kind of game theory, or like some kind of multi-agent kind of game theory, where if I take an action and I try and execute the $1 million I want to do, other people will react to that and the order book will change. So then there's a few different machine learning models that might spring to mind. You want to maybe do some kind of reinforcement learning. You might want to model this order book as a game, come up with a simulation for that. Maybe you want to do some kind of Bayesian modeling, because the thing about Bayesian, so for those of you who aren't aware, Bayesian modeling means thinking about conditional probabilities. If what is my best course of action given that the world looks like this? So given this context, given that the bid side is really top heavy and there's not much behind, and given that the offer side is, there's many levels of volume, but it's a bit thinner than the bid side. Given that, what is my best course of action? One feature you might derive is if you look at the order book on this depth chart here, you can see that the top level of the bid is much higher than the offer level. But when you move way back to the depths of the book, you can see that the offer side here is actually probably a bit thicker than the bid side. So what does that mean? Does that mean the market's going to move slightly up to here, and then it's going to hit this wall of people offering here, so not move any higher? Does this mean that all these offers have been taken out and now it's time to start taking out some of these bids and the market will move down a bit? These are features you can put into a machine learning model and help with your execution. That's a zoomed in version. So one type of model you could use is Bayesian graphical models. I've stolen this slide from my dissertation, but the idea here is that the idea is that you have all these different events that you may model as nodes on a graph. And then when these events do something, so let's say when the pound goes up or the dollar goes up, or Trump says something, or Apple stock price moves, can you do some kind of conditional probability to say, given this, given this, given this, what is the probability that the asset I'm interested in moves? Or in your order book example, it would be, given this is what the order book looks like, and I take this action, and then someone else takes this action, what is the probability that I should do this? Or what's the expected value of me doing this action? What's the expected value of me doing that action? Another Bayesian model that you might come across is the naive Bayes classifier. So the idea here, again, I won't go into too much maths. I don't really know why I even put this here, but the idea would be you have a whole bunch of actions you want to take, or classes, and you might decide, okay, what's the probability of this action being profitable given the context that I have right now? So you would look at, okay, what action becomes profitable given it's a Sunday, given there's not much liquidity on Sundays, given the price has just moved up, given there's $750 on the bid and $250 on the offer, and then given all these different pieces of context, which decision shall I make? And this is just the same example. You look at the probabilities of each of your pieces of context, and then you can combine those to get some kind of probability of to figure out expected values of different decisions. So the things you might want to predict are different actions, or the expected value of taking different actions. So you may want to choose what level to start putting your bid at. You may want to decide what size you want to put on each level, and whether you want to move up a level, down a level, given the different things that happen. Cool. So the last area I'm going to talk about is parameter tuning. which I think at first probably sounds like a strange topic for traders to think about, but actually it can be super interesting, and there's probably a lot of room for innovation in this area. So in order to talk about parameter tuning, it's probably best to contrast algo trading or machine learning with algo trading with what you would do if you didn't have machine learning or didn't have algo trading. So if I was just trading like voice, just Chris, watching the market and deciding which trades to put on, then I would probably have a whole bunch of different things I look for. I would look at like what happened yesterday. I'd look at what events are coming up. I would make some decisions about, how much is moving through the market right now, what different people are doing. And then I would decide to buy or sell based on that information. And then I would decide how much size to put on. I would probably decide how long to try to hold the trade for. And I'd have all these different inputs. And I would build, kind of in my head, different scenarios. Then if I was to code up those different scenarios, it would kind of just look like a list of if statements, right? So you would have like, if the market is liquid and it's a weekend and there's some big event happening tomorrow, and you would kind of code them up in a whole bunch of different if statements. And then once you had those if statements, you might want those if statements to be a little bit flexible. So you would have some kind of parameters that say, okay, if liquidity is over A, and if the weekend day is in, this list, and then you can actually come up with your if statements, but make them a little bit flexible by having different parameters. And then you would probably save down those parameters in some kind of file, let's say like a JSON or something else. And you can kind of think of this then as a reinforcement learning problem, where you're trying to achieve an aim, be it execution or alpha generation or something like that. And you have all these different parameters that allow your rule-based model to be flexible and to make different decisions. And then you would let your parameters, so you would build up a reinforcement learning model that allowed your parameters to change in order to optimize your goal. And then you could build some kind of reinforcement learning scenario where you tried to trade based on these parameters. You didn't get the right outcome. So you then change your parameters based on what your model told you to do, and then you kept updating your parameters until you got to some optimal parameters for whatever it is your goal was. And then you had your parameters, instead of being chosen by a human, were therefore chosen by your reinforcement learning and had used data to do that, which is and could be quite powerful. Cool. So that's almost all I've got to say. I wanted to leave you guys with some resources. I went through these slides at a really high level, but if you want to get into more depth, there's 2 good books I recommend. There's a whole bunch of good books, but these 2 are particularly good: Algorithmic and High Frequency Trading, Advances in Financial Machine Learning. Actually, the best resources, I think, more so than books, are blogs. So it's worth looking online for Medium blogs. Google Scholar also has lots of good papers. And as cryptocurrency is completely available to everyone, you can also just go onto an exchange, make a demo account, and start trying to write your own code to trade yourself. And it's relatively straightforward, actually. So I hope that was interesting, and let me know if you have any questions.
Fantastic. Thank you so much, Chris. There's a few questions in the chat that we'll start working through if you'd like to end your presentation. So cool. The first one, going back to the very start of your talk, you discussed that your institution or your site is for institutional investors directly, but so why can't institutional investors directly buy from the retail websites? What was the reasoning behind that for B2C2?
Yeah, no, that's a good point. So anyone can buy from the retail website. So if you're a retail trader, then you go onto an exchange like Coinbase or say BitMEX or any of the other exchanges out there, and you'll want to execute your trade. But the problem as a retail investor is that you probably have quite a lot of size you want to do. You want to do it very quickly. You're very price sensitive. So you essentially want to pay someone for the service of them executing for you. So let's say if you're a hedge fund and you want to put on $1 million of Bitcoin or $10 million or even bigger than that, then it's really difficult to go and do that on exchange. You need some like really good execution expertise to be able to do that. So instead, the hedge fund will come to someone like us and we'll provide that service for them. So if you look back at the order books that you can see on these different websites, there's only a limited amount of size that you could get done at one time. So if you're an institutional client that wants to do a huge amount of size, then you need quite sophisticated execution algorithms to do that trade, or you can come to a service like B2C2.
Sure. So just by the way, Val's here to ask the questions from the quant team. But before Val jumps in, I wanted to ask, what are the sort of impacts of these massive investments that you talked about? I think Square put in a fairly sizable investment recently. I know there are whales sitting around with thousands of Bitcoins. What are the sort of effects on these massive players on the market? Are they able to manipulate the Bitcoin market at all, or is it such a sort of diverse market they don't really have an effect?
Yeah, that's an interesting question. So as you say, Square purchased a huge amount of Bitcoin recently, and when they were going to do something like that, that's a perfect example of when they would go to, or probably go to, a market maker or a liquidity provider, because they want to, they have, say, like billions of Bitcoin to buy. It's really difficult to buy billions of Bitcoin, and when they start buying it, they don't want to push the price higher, so that by the time they're buying the last few, the market's already moved higher. So instead, they'll go to a liquidity provider to help them execute that trade. Now, you mentioned manipulation, and I think that's like probably the wrong word in this situation. Like, there's no possibility that they could manipulate the market, but obviously that they have some information that not everyone else has, and that information is valuable, because if they know that they need to buy a few $1 billion worth of anything, even Apple shares, even something very liquid, and then they know something that not everyone else knows, and they have some information there. But it's not necessarily they can't necessarily profit from that, because it then requires some kind of important trading strategy to profit from that.
I think there was I don't know if you remember the recent drop from about 10K to 3.5K or 4K that happened, I think, at the end of last year or early this year. There was some talk that was a sort of joint effort between a large group of whales that held massive amounts of Bitcoins, and it was like a joint effort to crash the price. Do you see that as being a viable option or a viable sort of possibility, or is that probably just more random than anything?
I mean, it could be. I think they would have had to have a huge amount of confidence in order to. So if you're owning a lot of Bitcoin, and I guess I haven't read the story, but I guess you're saying that they want to crash the market and then buy some more or something really cheaply, and that would take, like, obviously a huge amount of confidence, because it could have gone horribly wrong and all these different things. Secondly, I would find it quite hard to believe that it's even possible these days. Like maybe 5 years ago, when Bitcoin was really young, or even younger than that, and it was super illiquid, then yeah, you could move the market with some massive trades. But now it's a reasonably efficient market, and you can't, just by trading like a billion or a few billion, you can't actually have that much impact on it, not in the same way you used to be able to. So yeah, I'd be interested to know, but I would be skeptical.
So I don't know if Val wants to jump in with a finance question.
Yeah, I definitely have received a couple of finance questions from our WFS members, and the first question is really in regards to like your everyday activities as a trader, right? Because you've been in City and now you're like a quant trader. Mm-hmm. What do you think or how is modeling cryptos different from modeling any sort of different asset classes?
Yeah, I guess that's two questions. The first is like, what am I doing like day to day, I guess. So it's roughly a mixture between managing what's going on, like managing what our clients are doing on the day. So, we will get some risk. I'll get in the morning, we'll have some risk. I need to hedge that risk, maybe tune some parameters, maybe monitor how well our different trading strategies are doing, make sure that the price we're giving to clients seems fair and reasonable. And then I'd say the other half is probably thinking a bit longer term about longer projects. Can I go with some new models, some better ways of like helping our clients with what they want? And then you get a bit of time to like not think about the day-to-day movements, and then start building some models that takes a lot longer and do data analysis, which is obviously super interesting, and I guess part of the reason we're all here. So then your second question was, how is trading crypto different to other assets? I guess the naive answer is that it's not really that different. It's just another asset, and it moves up, it moves down, it has reasons it moves up, or reasons it moves down, and you need to just take those into account like you would with any other asset. But the more detailed answer to that is probably that it's still a relatively young asset, and because of that, there's lots of different things that you wouldn't get with a mature asset that you would get with cryptocurrency. And then there's the really idiosyncratic stuff like I don't know how much you guys know about crypto, but it's a currency that's all written in code, and this code can like do funky things, right? It rarely has bugs, but it does sometimes do things like split in two, and then so today actually Bitcoin Cash is forking, which means that two different developers on the high level version means two different developers that are working on the Bitcoin Cash project have different ideas about what to do with the code, and then one group will go one way, one group will go another way, and then actually the currency will split into two. And if you owned one Bitcoin Cash this morning, you now own one of the new Bitcoin Cash and one of the old Bitcoin Cash. So then that's like a weird thing you wouldn't get in normal currency markets, and traders need to be aware of that and monitor that as they're happening.
I'd really like to get into that a little bit more. Do you see sort of, obviously you're working in trading crypto, so I'm assuming that you see a future in cryptocurrency, or conversely, you don't see a future in fiat currency. Is that true, or do you think these two are going to sort of live simultaneously for a while? Where do you think we're going to end up in the future?
Yeah, so I guess we're getting a little bit away from AI now, but I'm probably in the last camp that you mentioned, where I think that they can live on simultaneously. Cryptocurrency, it's almost impossible to get rid of cryptocurrency now, unless because of the nature of how it works and the nature of how markets work, that it would basically require everyone who's ever interested in Bitcoin to all agree that it was useless now, and then that's some kind of like global coordination that's frankly not possible. So it'd be very difficult to get rid of it. Will it replace fiat currencies? Well, everyone has their opinion on that. My opinion is no. We pay taxes in our fiat currencies, and until you can force people to pay taxes in some other way, you won't get rid of them.
Sure. Taking a question from the chat now, Tom wants to know whether you think that sort of traditional handwritten algorithms are going to be superseded or replaced in the future by strategies, like more intelligent strategies involving machine learning, or do you think again that these two could sort of live on together?
I think well, so what a lot of places have now anyway, is that you have algorithmic strategies that require a human to like manage them. So instead of deciding do we buy or sell, it's more deciding what parameters we're going to have, or even if there's an algorithm tuning the parameters, it's like what's tuning the parameters of the algorithm that's tuning the parameters. And that oversight is surely going to be there forever, but then it just depends how far removed that oversight is from actually what the algos are doing. So yeah, I don't see like, it's not one of the, I don't have in other topics about AI, you say, oh, well, the humans will be completely replaced and then you'll never need humans again. I think the nature of how markets work, the fact that they react every time you do something, means that humans will basically be required in some form indefinitely. That would be my opinion. Or maybe I'm just saying that because I hope I don't get out of a job, but yeah, that's my opinion.
Now that we kind of like touch upon the subject of like trading strategies, by arguing like, okay, well, can algorithms kind of replace the algorithms that we as human beings come up with? You obviously have to feed these types of algorithms with massive data sets. Do you think that you're using alternative data sets than you would be using in like regular asset classes?
Yeah, that's a good question. So the most obvious data set that people use is historical prices, right? So like what's the price done over the last few seconds, minutes, hours, days, etc. And that everyone obviously uses that. And then on top of that, you can add alternative data sets like news or metadata or information about maybe who's been doing what or how things have been moving around the world. And we do use some alternative data, and it's possible to use other alternative data. But the thing that's worth mentioning for us, this is not really crypto specific, but more for market making, is that we're working on such a small frequency that we're not looking at like fundamental research. So if you were like a hedge fund deciding to take a position in Apple stock, I keep using that example, but over a year, then you would look at Apple research reports and you would look at their annual statements and things like that. and you would maybe do some NLP and some natural language processing on these different text documents you have. That's not really necessary for high frequency trading, and particularly because if there is a text document, it's almost always comes after the move on a low, not before. Whereas if you're looking at a long time scale, the text may become before, but in high frequency, it's typically after. I'm happy to be proven wrong there.
So we've got some more questions from the chat. Stefan wants to know, what exchange order books do you guys analyze? And since you're moving large amounts of crypto, do you have models to analyze OTC trades?
Yeah, so I can't go too in depth about exactly what we do and like which features we do, because as I say, that's part of our, like, that's what our business is like built on. But instead, I could say that because we're executing, we have basically two sides to our business. Our clients come to us and they execute trades with us, and we have good relationships with clients. We exist in order to serve them and to like provide a product for them. But once that we've done a trade with them, we have to turn around and try and hedge it on exchange. So then we have as many venues as possible to try and hedge those trades. And then each of them is slightly different. The way the products work on each exchange is slightly different. So we're doing kind of exchange by exchange analysis to try and do that. But it's all with the focus of like providing the best price for our clients, really, which at the end of the day is what our business runs on. Yeah.
Sure, I think we'll go for two more questions. I'll start with a question from James Palmer, who says, if there's a new trend in the market, with a lack of data surrounding whether it's just a bubble or not, how do you create an algorithm to see whether it's worth investing in?
That's quite an interesting question. So the thing is that, like, or at least in my opinion, just outright predicting what the market's going to do next is basically impossible, or like near enough impossible. Or if you knew how to do that, you'd be a billionaire already, and you wouldn't need to be at this talk. But instead, what you do is you try and model what is the probability of it doing this, what's the probability of it doing that, and then given the information you have, given the historical examples of what happened and what the context is right now, what is your expected value of each action, right? And that's kind of the way you think. So when it comes to, so the specific question was about whether or not you can predict bubbles and things like that. I personally don't look at the time horizon of being able to decide, like, is this week the top of the market or is next week the top of the market? I guess instead we're just looking at, like, what's the market doing in the immediate term. But I guess one thing to think about is when you're doing algorithmic trading strategies, one way of categorizing them is between mean reverting strategies and momentum strategies. So if you're thinking, like, is this the top of the bubble? You're basically saying the market's gone up. Is it going to mean revert and come back down? And that's a very different strategy to, I think the market's going up and I think it's going to continue going up. So then you probably have some different ways of looking at those two possibilities.
Fantastic.
Okay, well, I think I'm going to ask the last question from like the WFS members, and this is more of a, I would say, career-related question, maybe.
Cool.
So you started out as a rates trader at Citi, and what do you think was your relationship with the pricing quant back then? Now looking at yourself being a quant, how is your relationship with those rates traders?
Okay, yeah. So actually, one thing to go through, explain before I answer the question is that a quant at a bank does something very different to a quant at a hedge fund or at a market maker. And a quant at a bank is often the people the very smart people who build models and build like risk systems and pricing systems and things like that. And they can regularly code, they can do the mathematics to like build these systems. And then the traders rely on the quant systems in order to be able to place trades. At a quantitative fund or a market maker, the quant and the trader is basically the same person. So there isn't this relationship between, okay, the model that the trader wants, they need to ask the quant to build it. The quant goes away and builds it and then brings it back to the trader for the trader to use. Instead, like my title is quant trader, which means I'm coming up with models, then I'm using them, and then I'm saying, oh, it doesn't really work, and then I go back and I try and build a new model, and then I use it again. So so that's the context worth noting. So then to answer the question directly, when I was a rates trader, I was trading exotic products, so products where the price is not obvious. So you have to use some complicated maths, some like Monte Carlo simulations to figure out what the price is. So we had some quants who built some fantastic models, and we were like super reliant on the quants models in order to trade. So we had a great relationship with them because the traders recognized that we needed the quants, and the quants knew we were grateful. But in my new job now, we're all one team and maybe even the same person. So it's a bit different.
I see. Thank you.
Yeah.
Fantastic. So thank you so much, Chris. That's going to be the end of our questions for you. Just before you go, I wanted to find out whose question was your favorite. So I'm going to read them out quickly, and you tell me which one you like the most. So we had the question about institutional investors. We had the question about would it be counterproductive if the market was excessively traded. We had the question about the exchange order books, which you said you couldn't answer. We had the question out of the features of your sort of pricing strategy. We had the question about trends in the market and predicting bubbles, and we had the question about do you think that training with AI will remove the need for traditional traders?
Yeah. Okay. So I think I like the.
Oh, sorry. There's also some WFS questions. You had the questions there from Val, which I don't know if you can remember them.
Yeah. So there's one about the like modeling cryptos versus like different asset classes. What are the main differences? And then what kind of data would you be using for your trading strategy? And then lastly, the question I just asked about your
careers and stuff. Yeah.
It's all
cool.
on the line here, Chris.
Well, quite a lot of questions now. Now we think back to it, but no, I think the bubbles question was my favorite. Maybe because I thought my answer to that one was the worst. So it was the person who asked that question was thinking about the right kind of things, because if you can predict these complex events that do happen, but people get caught offside and there are big moves, then that's really valuable for whatever kind of service you're trying to provide to your clients. So.
Fantastic. Well, James Palmer, if you get in touch with us, we'll send you your hoodie. So I want to just let you know that right after this talk in the same stream, so if you guys stay here, there's going to be a careers fair where we have people from Google, Facebook, Uber, the Future of Humanity Institute, McKinsey, and more coming to talk to you about how you can get jobs in their companies. So if you stay put for another 5 minutes, in this same stream, we'll be back to bring you that. I want to say thank you so much to Chris and for Val from the Warwick Finance Quant Society for joining us here. And
thank you.
See you soon.
Bye.